take it here. Usually this January of every year, I do a look ahead, sort of what are the trends saying the coming year is going to be like. And when I did this in January, it was well before we knew anything about COVID-19. And we're going to see that some of those predictions are, totally overtaken by the events that happened this past year. And but we won't spend a lot of time on what happened last year. We'll also spend a little bit of time on what the trends are saying going forward, so that as investors, whether we're going to be limited investors, limited partner investors, or part of the general partnership, we can have a sense for what's going on a little bit. What kinds of things might we anticipate looking forward? This certainly is not. If I had a crystal ball and I knew exactly what was going to happen, you wouldn't believe me. So I don't have a crystal ball. These are my informed speculations. So if you're, as you continue to invest, please do so based on your own research and on your own understanding, and certainly with the advice of any other financial or legal professional that you seem fit to use. But this is sort of a look back and a look ahead, and one man's view of things. All right, let me see here. We're going to look at four main areas, and then we're going to get into trends. One thing I didn't do was if you could mute unless you have a specific question, and then once you have the question, unmute and go ahead and ask. I don't mind taking questions during the presentation, so please, chime in when you have a question. But we're going to cover a little bit about COVID. We're going to talk about the GDP. We're going to do a little bit of a demographic look and some multifamily sentiment. What are investors and large operators in the multifamily space? What are their sentiments on things? And then we're going to talk about these 6 trends that you can see here, and then we'll be done. So it won't take that long. Just a quick review.
After 10 minutes, did some stretches.
Hello? I'm sorry. 2020 was a good year for multifamily and sales. Was it a great year? No. Operations was challenging, but overall, based on what people were fearing in March and April, didn't happen. Rent payments pretty much, mirrored normal historical trends, maybe just a touch under, but not significantly so. Rent trends, though, or renters did change. There was a little bit of change in the mix. There was a move away from urban areas, especially gateway urban cities like New York and San Francisco, even like Philadelphia and LA. You're seeing a migration. We'll talk about that a little bit more in another slide. But where migration was up was in the suburbs. We saw rents go down in the urban areas, but we saw rents go up in the suburbs. And for those of us who live here in Montgomery County, especially in the Lansdale area, it seems like a lot of the renters that left Philadelphia came here. King of Prussia, Lansdale, Montgomeryville, this specific area saw the highest rent growth in a number of years in the Philadelphia area, while Philadelphia, the city of Philadelphia, saw a rent decrease. We did see, because of the virus and all the financial strain that it brought on the economy, that lending was more constrained. The banks started requiring significant reserves, anywhere from 3 months to over a year's worth of principal and interest payments in reserve on top of everything else. And they started to be a little even more conservative in their lending criteria. But cap rates were relatively steady. You would think through all of that we might see prices start to go down again, but they didn't. Cap rate trends was about the same as 2019. And in fact, they did compress a little further in the suburbs, but they went up just a little bit in some of the urban areas, as you might expect. So the overall nationwide trend was the cap rates were fairly steady compared to the year before. Vacancy rates started to go up, but not as much as people were afraid of or fear as they might have feared. Mainly due to COVID pressures. People didn't want to be out looking around for other apartments or wanting to move and mingle. So for the most part, a lot of tenants who might have normally moved tended to remain in place for at least another period of time. But the move to secondary and tertiary markets also strengthened due to the work from home caused by COVID. People are starting to see that if they can work from home, they don't need to live in Manhattan. They can live someplace else and still get the work done. So that's just a quick review for last year. I'm sure there's a lot of other things that I didn't cover, but these were some of the big ones that I was paying attention to over the course of last year. Now, with regards to discussing the pandemic and the virus, I don't deal with any discussions on politics on it. I try to just view the situation as it is and use the numbers as they are. I don't talk to whether they're understated or overstated. Just try to understand the current impact. And the elephant in the room was the virus. And we'll see here in a little bit that this is a virus-driven recession that we were in. This is a virus-driven economic constraints. Without the virus, we wouldn't be looking at a lot of the issues that we have today. In the United States, you can see the number of infected through today, number of deaths through today, and the percentage. And worldwide, you can see the same number. Back in April, when we discussed as a group the virus, the government estimates at that time were between 100,000 and 240,000 deaths, with 100,000 by last June. And we were expecting infections to maybe go as high as 4 million. And that seemed like a high number back then in April. Boy, were we overly optimistic on that number. We would take that number today. It's 4 million is a lot less than 24 million, and 100,000 or 240,000 is a lot less than 400,000 deaths. But the virus is the recession, and this is the main thing. It's the virus that's causing a lot of businesses to shut down, stopping people from doing a lot of traveling, eating at restaurants, and what have you, causing governments to shut down different aspects of the economy. And that's driving unemployment numbers. When and if we can get back to some kind of semblance of normalcy, whatever that term's going to mean here in the future, and how quick it'll come, is when we'll see economic pressures ease. Probably not before then. The U.S. employment projections from total change in jobs from Q4 of 2019 until the end of this year, Q4 of 2021. These are the expectations of a lot of the experts in the market, and you can see it by market. We're looking at potential increase in employment in Texas, in Austin, and in Dallas, and in Phoenix, and maybe a little bit in Salt Lake City. And then you start to see negative employment recovery, with Moody's demonstrating a little over a 4% national average of lower than expected employment recovery. So they're expecting negative employment recovery from where we're at today. That's not a good picture, but it's better than where we were a couple of months ago when we were at 30 to 35 million jobs lost, and unemployment in high teens or higher. So hopefully we can recover back to something closer to this midterm line here. Anything closer to that we can get, the better. But what this also points out is you got to pick your markets that you're going to invest in. And if you're looking at like Las Vegas, in my former hometown of Detroit, well, you probably don't want to be investing there, for the next year, because we're not going to look at a good jobs picture. If you're already looking in Austin and in Dallas, those are good markets as people are projecting for at least the next year. So pick your markets, understand what the job recovery is going to be in those markets, how hard were they hit, and then make your choices from there. From a GDP perspective, macroeconomic impact on the U.S. Investment in the U.S. is slowing or stopping depending on the company or the industry that you're in. In 2020, the growth was forecasted to decline by 2 to 6%. And you can see here, it was down overall in 2020 by 3.5%. They are forecasting GDP growth to increase by 4.1% by the end of 2021. And these are the quarters that they're expecting. They're expecting small growth in the first and second quarters, larger growth in the third quarter, which would be July, August, September, and then ride the fourth quarter into an overall 4.1% increase. I hope they're right. I will say that 2020 had an incalculable negative impact on lots of small businesses. I've read numbers of 50, 70,000 small businesses had to permanently close as a result of the pandemic. They got wiped out by being shut and not able to operate. And I don't think it's fully understood what the long-term impact of all of this virus and the pandemic and the shutdowns is going to have, even on the larger businesses. So that will, only time will tell on that. I think one of the areas we're going to see with the larger businesses is that with all the people that they laid off, I don't believe we're going to see 100% of those people return back to work. There'll be some number less than that. So we're going to see a larger number of unemployed for a longer period of time as businesses readjust. What are the interest rate expectations? First off, if we look at inflation, this is the number that's expected to increase or increase substantially, over 70%. If you look at commercial mortgage rates, which is what affects us in the multifamily space, they're expecting rates to increase almost 70, just under 70%, maybe 65%. Overall, they're expecting interest rates to increase in the next 5 years. And we know that is true because the Fed has said in 2023 they want to start raising rates. And we'll look at rates a little bit more closely here in another slide. They are expecting cap rates to go up a little bit, but that's about half the people. There's still a sizable number that expect cap rates to remain the same or even compress further. However, when you look at these three numbers, you can say, gee, that's going to affect property performance. Investor expectations are still high. So over here, you've got your limited partners are saying, I still want my high returns, even though you're going to have to overpay for properties, you're going to have higher interest rates, and you're going to have inflation. So those of us in the syndication side of the business, lots of luck to us. You can see the 10-year treasury rate here. You can see cap rates here, and they're both have been exhibiting a downward trend. And you're seeing a slight uptick here on 10-year treasury rates into the end of last year and the beginning of this year. And we'll look at that here in a little bit. Interest rates, the 10-year Fed rate is what drives interest rates for commercial backed mortgages, multifamily mortgages. And if you look at it from January 8th through January 14th, it's on the rise. Everyone thought we were close to zero. Well, we did get close to zero on August 3rd of 2020, and we've been on the increase ever since. So this is going to have an impact on the rate you're going to wind up paying to the bank. As this continues to creep up, so will your rate that the banks are going to quote you. Just keep that in mind if you're thinking you're going to have low rates for a long time, even though the Fed wants to maintain low rates into 2020, toward the end of 2023 or into 2024. They may go up sooner than we think, and we're starting to see some evidence of a slow pressure upward here. I talked about migration a little earlier, and you can see here the red dots are the cities that are showing an outflow of population, a net outflow, or out migration they call it here, and the green dots are net in migration. So if you're in the gateway cities, Boston, New York, Philly, Baltimore, DC, or even over in Chicago and Minneapolis, and then the western coast, the West Coast, you're seeing a net migration out of people. People are leaving these areas. And there's a lot of reasons why. You know, you talk about New York and their tax structure and their rent control. Same with California, Portland, some considerations to that in Seattle. Chicago, same thing. A state that's heavily in debt and has to tax their way out of it. I'm not sure why Minneapolis is seeing an outflow or Denver's seeing an outflow, but they are. But these people are leaving California and going to, well, some of them are going to Vegas, but they're going to Phoenix. They're coming to Texas. And the people from the Midwest and the Northeast are moving south, especially into Florida. Although we're starting to see a migration into the Myrtle Beach, Charleston area. which are, right along the coast there. So if you're looking in these areas, you're going to continue to probably see a net in migration of population. On top of, when you add on top of that, that businesses are moving there here, you're going to see a net increase in employment as well, and that's going to drive more of a population trend toward these areas. The more business-friendly states are going to attract a larger share of the population. And it helps if there's no snow in the wintertime in most of these places. For those of us who've lived up in the North Country during the winter, that can be an attractive draw. Overall look for 2021 for major commercial property types. Now, this is just a national overall assessment by experts in the field. We focus on multifamily, but you can see that the outlook has dropped from last year to this year by a pretty good number, from 3.55 on a scale of 1 to 5 to 3.39. And the same for new development projects, it's decreased. The overall assessment or outlook. When you compare that to industrial and distribution, and where it just keeps getting stronger, that's your warehouses, your Amazon, fulfillment centers and stuff. That's what's driving the industrial distribution piece of it.
Hey, Dennis.
Yeah.
On this particular slide, in terms of multifamily housing, they're profiling new construction, correct? Not stuff that's already built.
The left side, I believe, is just an overall assessment of the market. The development prospects would be if you want to do new builds.
Oh, okay. All right. Thanks.
Now, if we take a look at that and we break it down a little further, these red arrows are moderate income apartments or workforce apartments, low income, high income, senior housing, and student housing. The circle with nothing in the middle of it is last year. This is where they were rated last year. And then the full circle, or the blue, it's green on my screen, so hopefully, I don't know what color it is on yours, is what the expectation is or the outlook is for this year. And you can see here, from an investment prospects perspective, every multifamily property type is listing their expectations are less than last year, which reflects the number that you saw on the previous slide. Same with the development prospects. About the only area that showed a positive outlook is the fulfillment centers, where Amazon keeps building like crazy. And single family rentals. Because the single family market now is so strong and the supply is so low, we're starting to see a lot more attention paid to the single family side of real estate investment than multifamily or hotels or retail. What is investor sentiment on profitability, and how has it changed from last year to this year? As we can see down here, this purple section is people are expecting a better outlook this year than last year, but only 12%. Almost 34% expect things to be the same, but almost 54%, more than half, their expectations are lower for this year than last year. That's just investor sentiment. Keep that in mind when you're talking to people about your projects, that probably half of them are expecting things to be worse than last year, but a third of them are expecting things to be the same. So very few are expecting things to be higher, but they're going to want the higher returns anyway. So let's talk about the trends a little bit. One of the things that always impacts multifamily is the delivery of new units or new properties. We did see a number of that, a large number of that last year, and they're expecting new deliveries in 2020 to keep the same pace as the last 2 years, which is about 300,000, well, as last year. About 300 new units is the expectation, along with the absorption. So if you look here, you got 240 net deliveries, and absorption is expected to be a little over another 120,000. 80% of these are going to be Class A properties, and leasing is going to continue to be competitive. And remember that when we look at a couple of future slides. But coincident with that, if you look at this red line, this is vacancy expectations, and we'll go into that in a little more detail here shortly. But vacancy is expected to jump above 6.25% for 2021. And that's as a national average across the board for multifamily. Vacancy and rent growth. It's expected to increase 180 basis points to about 6.5%. And along with that, rent growth is expected to decline to 0.9 to 2.2%, depending on who you listen to and who you talk to. So if you're evaluating properties and you're looking for a 3 to 5% rent growth, you better understand that your market can do that because on a national average, the experts are saying that you're not going to see that level of growth. But overall demand is still expected for rentals to remain high, mainly because of the cost of single family homes and the number of people returning back to work, or maybe they're not working as much and they're not earning as much. So they're going to need to stay in the less expensive apartments as opposed to buying a home and having to deal with the mortgage and everything that goes with that. Last year, 2020, this chart here on the left tells you what 2017, 18, and 19 looked like. And the expectations were that we were going to meet or beat that in 2020 until the pandemic hit. And you can see that here with this purple vertical line. And this is what happened to rents due to the pandemic. We saw a negative rent growth. In other words, nationwide, on average, rents decreased almost 1.5%. In some areas, they were down quite a bit more, and we'll see that in a minute. But occupancy rates, the projection, this is what they were in 2020, and the projection for 2021 and 2022, as advertised by CoStar, RealPage, Yardi, and CBRE. For 2021 going forward, CoStar is expecting only a 0.9 rent growth and about 8% vacancy, or 91, 92% occupancy. So depending on whose data you believe of these four, you might want to plug these numbers into your evaluation when you're looking at properties. Here's a picture of what happened with the top 10 metros that had rent reduction. And we saw some significant rent reductions in the major cities around the country. Almost minus 27% in San Francisco, New York 20%, Boston 20%. Unbelievable big drops in rents. Although I'm not sure that you can find a 2-bedroom apartment anywhere in New York City for $1,600, but this is the average that they had. Large drops, and that's why, and that's due to people leaving, and they have to drop rents to attract them. They also have to up their concessions, and we'll talk about that in a minute. However, the rent growth wasn't bad everywhere. In some of the hotter markets in Texas and down south, you still saw rent increases. And if you were in suburban areas around some of these larger metros that saw rent decreases, you saw rent increases. Like I said, here in Montgomery County, we saw rent increases of close to 5%. Whereas Philadelphia, you saw a rent decrease as shown on that chart. So overall, if you were looking to invest in the suburbs, you saw a net rent increase, whereas a lot of the principal cities saw a rent decline. Rent growth by property class, Class A, Class B, or Class C. They all took a dive into the fourth quarter of last year, and only B class properties showed a slight uptick coming into this first part of this year. And I think we can probably see that going forward. And the reasonings for that are Class A properties. There's just so many of them. People having a choice, and or with some of the prices that they're paying, they can buy a house. They can afford to buy a house. These are the people who are renting because they choose to, not because they have to. And the C class properties, they're the ones hardest hit by the pandemic due to loss of income or reduction of income. And we're not going to continue to see a large rent increases or rent growth there until the economy comes back and those people feel like they can pay the rent. Only place we're going to see that probably is in the Class B garden style suburban properties right now. Last couple of meetings, we talked about concessions. And in fact, I had even talked about a Class A property that came on middle of the year in Philadelphia, and they were winding up giving 4 months free rent to try to get people to sign leases with them. And that's what I mean by a concession. Concession rates went, from the beginning of February in the 7% range up to over 10%. And you can see that that was true though across all three classes of properties. More and more property owners had to give concessions to get or retain to retain their current tenant base or to bring in new people to fill their vacancies. Also, the percentage of properties having to offer concessions increased from an average here in 2019 of about 9%. In some instances, almost double that. So more and more properties had to offer larger concessions to either retain their current tenant base or to attract new ones. I don't see that stopping for the first part of probably the first 6 months of 2021. But if we really see some improvement in the virus situation, whether it's through the vaccines or otherwise, and we start to see more people going back to work and earning money again, that's when I think we'll see concessions and the number of properties giving concessions go down. Workforce housing. This is something I pay attention to for a couple of reasons. Like I said, most of the new construction is Class A property, and that's for about 10% of the renter population. This is not a problem that an individual syndicator can fix. It's not a problem that a number of syndicators can fix. It's going to take a lot of government intervention. But the problem is more and more of the renter population is coming under financial stress, not just due to the pandemic, but in general. And it's causing a greater need for lower class or for lower priced housing that's just not available. And this particular chart talks to, home prices are up, construction costs are up, household income is not keeping pace with those two increases. And this consumer price index, which is the cost of goods just to live, is also going up. So it's harder and harder for people to buy a home. So they're forced to rent. The problem is, can they afford the rent? When we look at renter income, the government defines financially stressed for renters as someone who's paying greater than 30% of their income in rent. They're severely financially stressed when they're at the 50% mark, and that's what this chart depicts. When you look at income categories by the amount of that income spent on rent as a percentage, people who are earning less than 15,000 or less, that should be the other way, but 15,000 or less, 72% of them are spending greater than 50% of their income on rent. If they're earning 15 to 30,000, 43% are spending 50% or greater of their income on rent. And in these two areas, I don't know how you live, if you've got to spend $1,400 or whatever the number is, probably less, but $1,400 in rent, and you make this kind of money. I don't know how you make ends meet. $30,000 to $45,000, 56% of the renters are at 50% or above of their income on rent. And that's up from 50% in 2011. So over the last 10 years, a greater number of people in this income range now have to spend more on rent as a percentage of their income than they did before. And in the 45 to 75,000 income group, 27% spend 50% or higher, and that's up from 22%. So another 5% are spending higher. So the trend is up in these four income areas of people spending 50% or more of their income on rent. However, along with that is the number of low-cost housing units has shrunk from 33% of the total rental stock to 25%. So people have less opportunity to find places to live with the lower cost housing numbers. And what's driving that? Frankly, the last 10 years of multifamily investing, where we've done value add activities over those 10 years, from 2011 until now, has been the sweet spot in multifamily investing. Been probably the largest or the best investing environment in decades for multifamily investing. And all these people, all these syndications, all these companies that are buying properties are looking to raise rents 3, 4, 5% every year or higher if they can. They're also taking properties that are low income housing properties out of the low income housing programs and turning them into market rate rent properties. So what we're seeing is less opportunity for these people to find affordable places to live. Does that offer you opportunity? I don't know. It's certainly something to look at and worry about, because at some point there's going to be a breaking point, and either the government's going to step in and do something we don't like, or there may be an opportunity here to hedge a bet somewhere and use this as one of the pieces of your investment pool for multifamily. Last year we talked about rent control, but rent control really got taken over by the pandemic and government eviction moratoriums. We have not seen any more states add rent control. Frankly, they probably just didn't have the bandwidth to do it this year, but there's only 5 so far. We've got New York, New Jersey, and Maryland have some either statewide or localized versions of rent control, and then Oregon and California. Not coincidentally, those are some of the biggest areas where people are moving from and leaving and going to other states.
Hey.
Go ahead.
Yeah. So I know they were trying to institute that here in Philadelphia. It was towards the end of 2019. There were some rumblings going on about that, and then they were going to try to institute it in 2020, but then of course with everything that happened, I guess that just fell by the wayside, because I know a lot of single family home investors. We were kind of like up in arms about that.
Yep.
That they were trying to institute that, but it hasn't happened as of yet, and hopefully it won't happen. But we'll see.
Well, and it's hard to say. I mean, the same was true with Chicago. They were looking to implement the citywide rent control there as well as here in Philadelphia. And there were a couple other cities. I don't know if Cleveland was involved, and I think Detroit was. Where they were trying to put some limits on what landlords could do as far as raising rents and stuff. And the pandemic did sideline a lot of those activities, right? But we have a different administration in now, different sets of priorities. In fact, I saw an email today that was talking about what the impact of the incoming administration might have, because everyone's worried that it's going to change and take away a lot of the benefits of investing in real estate. But what they were focusing on was that it might be an opportunity to look at opportunity zones, that they may increase and expand opportunity zones for developers or for people looking to invest in real estate, so that it can wind up helping this situation where we just talked about, like I said, it was going to require government intervention for affordable housing. So keep an eye on what happens with the new administration relative to opportunity zones and what opportunities that may bring for housing. Now, I don't know if that's going to also include rent control or not. That's something to consider, but we'll see. Just understand that a lot of people in the Senate and in the House are real estate investors themselves. So I don't expect anything too crazy in the first year or two relative to changing the landscape for investors and the benefits of real estate. Cap rates, again, relatively stable in 2020. We expect them to remain about relatively stable in 2021. I have seen value add Class B and Class C properties listed with cap rates in the high 4s. That seems crazy to me, but certain markets, that's what they're asking. So if you can make it work, great. If you can't, stay away. There's been a lot of talk over the last year and a half that there's, trillions of dollars on the sidelines waiting for, some kind of break in the real estate market. While this might have an ability to keep cap rates down, I don't think it's going to be the total driver to reduce the cap rates. You can see here what, as of the 17th of January, what the current nationwide averages for cap rates on these class of properties. I would love to see a value add at a 6.4 cap rate. If anyone has one, let me know. Usually I'm looking at them in the low fives right now. In fact, I was just looking at one in Tampa. It's in the low fives. International investment, another avenue to money investing in U.S. real estate. It was forecasted to be higher in 2020 than it was in 2019, and you can see those numbers here. They were expecting over 200 billion in investment. Obviously, we didn't get that. Obviously, the pandemic was driving a lot of that. They are expecting 2021 to see an uptick, but that's still lower than we've seen since 2015. So again, international money shouldn't be a big driver on property prices in the multifamily space. It'll have an effect, but the money on the sideline and international money, I don't think are going to be the prime drivers. It's going to be how well can a property perform, and what are investors willing to pay to get those returns. So expectations. For most of us, the smaller syndicators, managing our investor expectations, like you saw in that one chart, is going to be key to your successful subscriptions. In a world where we're looking at 4 and 5% cap rates, 10 to 12% cash on cash returns are not likely to happen, not unless you're really taking on a major repositioning. Accordingly, also people looking for 18 to 24% average annual returns, that's likely not going to happen either. I've been seeing a lot of opportunities to invest here recently come across my desk, and they've been looking at 6, 7, or 8% cash on cash return, and they've been looking at somewhere between 12 and 14% average annual return. So managing your investors' expectations is going to be key to being successful to taking on a property. That's all that I have.